Hello to everyone that has joined. Thank you so much. We'll give it just another few seconds as our participant count is still climbing, and then we will dive right in because we just have a short 30 minutes together today.
And there you go. All right. Hi, everybody, and welcome to today's webinar on California Climate Reporting Countdown. My name is Allison Carlson, and I will be the moderator today. I am the training specialist at Bureau Veritas North America. So let's go ahead and jump on in because there's a lot of things we want to cover. But before I hand it over to Brianna, I do want to go over just a few things about what we do here at Bureau Veritas. All right. So Bureau Veritas is a world leader in inspection and certification services. Created in 1828, the group has approximately 82,000 employees located in more than 1,600 offices and laboratories across the globe. Bureau Veritas helps its clients improve their performance by offering services and innovative solutions in order to ensure that their assets, products, infrastructure, and processes meet standards and regulations in terms of quality, health and safety, environmental protection, and social responsibility. Bureau Veritas is a business to society service company that contributes to positively transforming the world we live in. We work closely with the clients to address the critical challenges they face and to link these to and the emerging aspirations of society. We work with companies to build and protect their reputations, supporting them as they forge the foundations of trust that are built to last. And two things I want to hone in on here is our inspection and certification. Our inspections involve on-site verification that products, services, assets, and facilities meet specifications and operate as intended. They cover a wide range of services designed to control quality, verify quantity, and meet regulatory requirements. Our inspection services help companies have confidence in the reliability and integrity for their products, assets, and systems. And our certifications. As an independent third party and accredited certification body, we provide certification services to attest that management systems, services, and personnel comply with specific standards. Equipment and products can be certified to meet sector-specific or industry standards, international, local, or voluntary standards, or manufacturer client requirements. Certification enables companies to access new markets, strengthen their brands, or simply obtain an license to operate. And a few housekeeping things here today. I'll be keeping microphones and cameras off. If you have any questions for Brianna, we will be opening up the chat box, so please utilize that. You can do it anonymously. If you would do that, that's not a problem. If we don't get your question answered, we'll definitely have Brianna reach back out to you later via email. And also this webinar will be recorded, and we will make sure that we get it sent out in a follow-up email on Thursday. And also, one last thing, I will be doing polling questions. Those are 100% anonymous. Please participate in those, and so we can ensure that our clients are getting what they need. So let me just give you a little bit of backstory here with Brianna. She's quickly becoming the face of Bureau Veritas sustainability with all the videos she has been posting on LinkedIn and YouTube lately. It's been a great asset to our team with all the knowledge that she's been able to give out. She is Bureau Veritas' senior sustainability consultant. Brianna advises companies on sustainability practices that drive business outcomes and ensure compliance with evolving regulations. With expertise in climate reporting and disclosures of climate-related risks, she brings both practical experience and deep knowledge of the emerging roles. So I'm going to go ahead and hand it over to Brianna.
Awesome. Thank you, Allison. I'm going to go ahead and take over screen share here. And let's get moving. So thank you all to have joined, all of you that have joined our 30-minute webinar today. Like I mentioned, we have a lot of content to run through. And if you have questions, please feel free to drop them in the chat, in the Q&A box. If we don't have a chance to address them today, I will follow up with you personally via email. Like Allison mentioned, I'm a senior sustainability consultant here at Bureau Veritas. We are a global publicly traded testing, inspection, and certification company that provides end-to-end sustainability services for our clients. I have had the pleasure of following the California climate regulations since they were introduced. And while there are still a number of open questions, there is now a clear path for its compliance. And I'll share some of those key items, requirements, and updates today. If you would be so kind, I'm always curious to know where everybody is dialing in from. So if you could drop in the chat where you're calling in from, just a good way to see the presence that we have on the call across the states, across the globe. Always cool to see. So with that, let's dive in. I want to level set by providing a bit of an overview of Senate Bill 253 and 261, just to make sure we all are on the same playing field. So Senate Bill 261 is the first of the two regulations, also now referred to as the 200s. This regulation mandates that companies with 500 million or more in revenue that are doing business in California must publicly disclose a climate-related financial risk report on a biennial basis. The first of these reports is coming up very quickly. The due date is January 1st, 2026, so we're only a few months out from when those reports will be due. This legislation specifies that these climate risk reports should utilize the framework developed by the Task Force on Climate-Related Financial Disclosures, also known as the TCFD. This framework is recognized globally as a standard that provides a comprehensive, structured approach for companies to assess, manage, and transparently report on their climate-related risks and opportunities. A key update that you'll notice included on the slide here is the annual fee. CARB shared during their latest workshop, which was this last August, the fee structure that has been proposed for this regulation and those companies that are subject to it. The annual fee that is expected is $1,400. It is important to note that although this reporting requirement is on a biennial basis, the annual fee is just that, it's annual. So important to note, this new law applies to a broad range of companies that are doing business in California, regardless of their headquartered location. So most organizations that meet the 500 million revenue threshold and have a presence in the state will likely be subject to these disclosure mandates, but we'll dive into the more specifics here shortly. So now let's move into the second bill, Senate Bill 253. This piece of climate legislation requires companies with 1 billion or more in revenue that are doing business in the state of California to publicly disclose their scope 1 and 2 greenhouse gas emissions, which are proposed to be due by June 30th, 2026. The inventory should reflect the 2025 fiscal year, and a year later in 2027, companies will need to report on their scope 3 emissions. It is really important to note that a limited assurance statement is required upon submission of your greenhouse gas inventory due by June 30th, meaning you should be looking to secure a limited assurance partner over the next couple of months in order to ensure compliance. The following slides that I have here provide a comprehensive review of the reporting timeline and assurance requirements, but just before I dive into that, you'll notice here as well the annual fee for Senate Bill 253 for companies that are subject to it is about $3,000. So looking at the disclosure timeline, starting in 2026, businesses will need to submit 2 different reports. The first is going to be that climate risk report. This is what you see denoted in that red text and icon. These reports are due January 1st, 2026, and then every 2 years thereafter, so 2028 and then 2030. This report is meant to provide an assessment of the company's exposure to climate-related risks and their plans to mitigate those risks. The second report is going to be the greenhouse gas emissions report. This is covering scope 1 and 2 emissions. And like I mentioned before, this is going to be due June 30th, 2026, accompanied by that limited assurance statement as well. Looking ahead to 2027 and beyond, greenhouse gas emission reporting requirements will expand to include scope 3 as well. The assurance requirements for these emissions reports will evolve over time. By 2030, the assurance level for scope 1 and 2 will move from limited to reasonable. And then you'll notice limited assurance will be required for scope 3 starting in 2030. It is important to note that the California Air Resources Board is proposing the greenhouse gas emissions reporting deadline as part of their December board meeting, and the final ruling is expected to be shared late December. So that June 30th deadline was a date that was communicated by CARB as part of their most recent update, but it is still required to be voted and approved on by the CARB rulemaking board. Now that we've reviewed the regulations, let's dive into some of the definitions, some of the key updates that CARB has shared. So one of the biggest questions that we see is how revenue is being defined. So in CARB's latest update, again, this past August, they shared two proposed definitions for revenue. So the first definition states revenue as defined by the California Revenue and Taxation Code. This defines gross receipts as representing a comprehensive measure of total financial inflow before any deductions. This definition captures all incoming financial resources, including sales, service, and other business income, providing a standardized approach to financial reporting and taxation. The second definition, however, reflects that revenue is defined as total global sales or money received from a company's primary business activities, meaning this definition is zeroing in on sales as a result of those primary activities as opposed to potential other revenue streams as definition 1 includes. This definition does not deduct operating costs or other business expenses and is consistent with metrics used by major data tracking and reporting industries such as Dun & Bradstreet and Standard & Poor's. Moving forward, if you are you're in the spot where you're trying to figure out whether you are subject to this regulation, depending on how revenue is defined, I would recommend including your tax and legal team into the discussion. Review the revenue values from both definitions and have those on hand for when CARB releases that finalized regulation, which again is set to be sometime in December. Now, when it comes to the definition of doing business in California, this is a definition that was proposed by CARB in the past and has not been modified. Since the regulation itself does not define what doing business in California means, CARB has looked at the California tax code to define this. So according to the tax code, a company is considered to be doing business in the state of California if they meet any of the following on the slide here. So engage in any transaction for the purpose of financial gain within the state of California, are organized or commercially domiciled in California, or your California sales, property, or payroll amounts exceed any of the values that you see on the screen. So similarly, if you are a company that's in a place where you're trying to determine whether or not you are considered to do business in the state, I would recommend reviewing your California-based operations, transactions, sales, property, and payroll values, and compare them to what you see here on the screen. You can also find this at the State of California Franchise Tax Board's website for direct reference. During the most recent workshop, CARB did propose a couple of exempted entities. So nonprofits would not be included in the regulation. Companies whose only business in California is the presence of remote employees. Government entities were already not included in the regulation. And then California independent system operators or business entities whose only activity within the state consists of wholesale electricity transactions that occur in interstate commerce. So if that is you, you are proposed to be exempt from the regulation. An important update that CARB released just a couple of weeks ago is a preliminary list of reporting / covered entities. So this includes all of the companies that are subject to the regulations that were identified by CARB via the means of their the data that was available to them. However, it does not include all of the companies. CARB has reiterated that each potentially regulated entity remains responsible for compliance with statutory requirements, regardless of whether or not it was included in the staff's preliminary list or outreach. So you'll see if you were to go out on the CARB website, you would be able to find this preliminary list of companies that is shared via Excel. You'll see in the first column whether or not the company is subject to one or both of the regulations, and then who that company is. So a great resource to go and look out to and see if your company is included on there. If your company is included and you think you qualify for an exemption, or you're not included and you would like to voluntarily share that information, CARB has released a stakeholder survey where they are seeking stakeholder feedback. They want to know if, again, if you weren't included on that preliminary listing and you should have been, or if you believe that you qualify for an exemption, you can go out to CARB's website, fill out this survey, and submit it, and you should hear back from CARB. So just to reiterate, though, again, each potentially regulated entity does remain responsible for compliance, regardless of whether or not you were included on that initial list of entities subject to the regulation released by CARB a few weeks ago. Another item that is not necessarily a new update, but something to keep in mind, CARB has stated that they will not take enforcement action against companies that demonstrate a good faith effort in their fiscal year 25 reporting. So you can see this enforcement notice was released this past December, so it is fairly dated, but it's basically CARB's way of saying we recognize that companies need time to implement new data and collection processes that allow for complete compliance with Scope 1 and 2 emissions reporting. And so as long as the company is providing a good faith effort in reporting their Scope 1 and 2 values, you can expect to not see any enforcement action taken against your company. So with that being said, I'd like to dive into the TCFD and some of the requirements that are outlined in Senate Bill 261, which is coming up this January. So we are running very low on time. In CARB's latest update, they introduced the concept of minimum reporting requirements as it relates to a company's climate risk report. CARB had previously received a lot of feedback on what constitutes a good faith effort when it came to climate risk reporting. And in response to that, they have released this draft checklist that you see on the slide, which does mandate minimum disclosures. So as you are reviewing, gathering your TCFD disclosures, I would recommend pulling down a copy of this draft checklist and doing some cross-checking just to make sure you are adhering to all of those requirements. What you will find, though, is within the first year of reporting, CARB has indicated that in your TCFD reports that are due January 1st of 2026, greenhouse gas disclosures are not required to be included, as well as scenario analysis. So for those companies that already are reporting their emissions inventory and have conducted scenario analysis and have reported on it in the past, it is recommended and encouraged that you continue to include those disclosures moving forward. However, for companies that are still working to get their greenhouse gas inventory developed and established and have not yet conducted conducted scenario analysis, it is not something that is required for this first year of reporting. Again, CARB recognizes the resource intensity of these activities and wants to give organizations some runway to develop those processes ahead of time. So as it relates to the TCFD framework, this framework is globally recognized as the main framework to report climate-related data and information. It actually is being integrated into the International Financial Reporting Standards, ISSB's framework, the International Sustainability Standard, S2 standard. So you'll see here, CARB has indicated that you are welcome to align with the TCFD framework or IFRS's S2 framework. Again, they are virtually the same. So the TCFD framework has 4 key pillars, which include governance, strategy, risk management, and metrics and targets. And within each of these, there are a couple of key questions that the stakeholders are looking for. So within governance, this requires companies to disclose information about the board's oversight of climate-related risks and opportunities, as well as the role of management in assessing and managing those risks. It's important for companies to demonstrate how climate change is integrated into the overall corporate governance structure and decision-making process through this pillar. The strategy pillar, as part of this, companies must disclose the actual and potential impacts of climate-related risks and opportunities on their business, strategy, and financial planning. So this includes identifying those risks and opportunities they face in the short, medium, and long term, and how these factors are incorporated into the organization's strategic planning. And then risk management, this section requires companies to explain their processes for identifying, assessing, and managing climate-related risks. And then lastly, metrics and targets. This focuses on disclosure of relevant climate-related metrics such as greenhouse gas emissions, as well as any targets used to manage climate-related risks and opportunities. For example, if you've set a science-based target, an emissions reduction target, that would be included in the metrics and targets section of the TCFD framework. Just to give some more clarity on the TCFD recommendations, this is a screenshot of the table that you will find within the TCFD recommendations report. You can see across the 4 pillars, the recommended disclosures A through C. Again, most of these, not all of these, you will find directly included into the draft checklist that CARB released a couple of weeks back. So again, I would recommend reviewing your current TCFD disclosures in alignment with the table that you see here, as well as that draft checklist that CARB has shared. So with that, want to come to a close here with just an overview of Bureau Veritas's end-to-end sustainability services. I do want to answer any questions that have come through. If you haven't had the chance to jot anything down, feel free to use the Q&A feature. Again, if you want to follow up via email separately, I'm happy to do that.
Hi, Brianna. There has been a few questions. I'm going to go ahead and ask you those so we can make sure people get what they need. So the first question is, if so, you opt out completely for both, the fee is less than $5,000 annually. And this was toward the beginning of at the beginning of when you started.
Yeah, so let me make sure I'm understanding this question correctly. So sorry, I'm trying to find, Allison, can you just repeat that? If you opt out for both, or if you're subject to both of the regulations?
It says based on the first 2 slides, if you opt out completely for both, the fee is less than $5,000 annually. Question.
Yeah, so good question, and there's some additional clarity that would be helpful here too. The fees are going to be specific to if you're subject to both 261 and 253, you would be paying both of those fees separately. Another important consideration to keep in mind is Senate Bill 219 was introduced to streamline and make a couple of changes to the 200s. And as a result of that regulation, that amended regulation, they introduced the concept of parent-subsidiary relationships. And so if you are part of an organization that is reporting at the parent level, but you have a number of subsidiaries that would be subject to the regulations individually, the fee does not also aggregate or does not consolidate at the parent level. The parent can choose to pay the fee for all of the individual subsidiaries, but you would still be required to pay the fee per reporting / covered entity. So just something to keep in mind, it would be that 1,400 times how many ever companies that are subject in your structure, or the $4,000 or $3,000 dollar fee per covered entity. Hopefully that answers your question. If not, you can feel free to follow up via email if I misunderstood.
Yeah. Okay, the next question is, if my company's annual report includes all requirements, can I just submit the annual report for all three tasks?
Yes, you can. So CARB has indicated that they want to make uh, compliance with Senate Bill 261 and 253 as easy as possible. And obviously, they're trying to put in a lot of mechanisms to do that. And so there will be a public docket available. I believe it goes up December 1st on CARB's website, where you will be able to submit your TCFD report due by January 1st. You can submit your existing report. You can submit a standalone TCFD report. Wherever you have those disclosures available to date, if you don't want to do any additional work to break them out separately, CARB has indicated that they're happy with more information rather than less. And so you're welcome to submit your annual report to ensure compliance.
Great. The next question is, what if you have two offices in California? Would they both be covered under one fee, or would they count as a separate entities if both under parent company?
Yeah, if they are separate entities that meet the regulations both individually, they would have separate fees. However, if they are just two offices that are part of a single entity that has operations in California and maybe other places in the state, it would just be a single fee. It depends on if the legal structure, the entity structure of the organization.
Okay. I'm just going to keep on going.
Yep.
So the next one is regarding SB 261 on January 2026, I'm supposed to disclose FY 2025 TCFD report. And then there's a two-part. Our parent company's report will be out late February 2026, but we have our 2024 report online.
Awesome. Yeah, great question. So Senate Bill 261 is a bit more flexible than Senate Bill 253. So 261 has, CARB has stated that you are able to use the most recent available information to publish your TCFD report. So if that means information from 2024, maybe you conducted your climate risk assessment in 2024, or that's when you gathered the disclosures and you don't have anything for 2025, fiscal year 2024 is perfectly acceptable. Now, if we were to look at Senate Bill 253, you would need to report fiscal year 25 data. The concept of most recent available data does not apply to Senate Bill 253. Allison, can you repeat that second part of the question? Sorry.
No, you're fine. Let me go back to it here. Okay, it says second part is our parent company report will be out late February 2026, but we have our 2024 report online.
Yes. So the public docket where CARB is collecting all of the TCFD reports opens December 1st and is open, I believe, until July 1st. So you are welcome to submit your February 2026 report to the public docket and make a note just indicating this is the most recent report now available. You can leave it to CARB to see whether they'd like to review the first report that you've sent in or the second, but you would be compliant with the regulation.
Okay, so this is going to be our last question, and it's pretty big, so I think it might take up some time. So it says, I'm reaching on behalf of the ESG team of Semiconductor Company, as well as as we prepare our client-related financial risks and disclosure report in alignment with the SB 261. We would appreciate clarification on the required geographic scope for the qualitative climate risk and opportunity assessment. And then it says here, sorry.
No, you can go ahead.
It says specifically only company, there's A, B, and C. A is only companies operations in California. B, all of companies US based operations, or C, companies global operations.
Yep, great question. Great question. So I always like to advise my clients that when conducting a climate risk assessment, when understanding risk at the organizational level, it makes sense to do that process in alignment with the existing enterprise risk management approach. So if your enterprise risk management assessment or enterprise risk assessment is facilitated at the national or global level, I would recommend adhering to a similar means of carrying out the climate risk assessment. I would not recommend just looking at California specific operations. The assessment is really meant to be much more comprehensive in nature. And so doing it just specific to California would limit a lot of the risks and opportunities that you would otherwise identify if you were to be doing it at a much more comprehensive level.
Great. Thank you. There's tons more questions that are still coming in. I will definitely get those to Brianna so she can reach out to you guys individually. Also, we have a workshop that is coming up here in November. I did put that in the chat so you guys can look that over. I think a lot of these questions that you're having, if you take the workshop, it will definitely answer some of these questions. And Brianna is the one teaching this course, so it's going to be a good one to do. So you definitely keep coming in for keep giving us the questions. We can keep answering even though we go away. Thank you, Brianna, so much for today. Definitely a great another informational webinar that we've done. So I do appreciate your time.
Yeah, absolutely. Happy to chat with any of you. Allison dropped my LinkedIn, my booking link, as well as my email. I'm happy to answer any questions or chat with anyone through any of those means of communication. If we weren't able to answer your question, though, we'll reach out to you via email as well. Thanks. Have a good day.
All right. Thank you. Bye.